My name is IS Academy and today we are going to see economic current affairs. In economic current affairs, we are going to see the rest of the things. So in our last video, we have discussed the first 8. In this video, we are going to see the rest of the things. So first, let's start with the revision of first 8. So first one is accommodative monetary policy. Accommodative monetary policy is nothing but the central bank will cut the interest rate to inject money into the market. So RBI has cut the interest rate means then automatically bank is going to reduce their interest rate. If bank is going to reduce their interest, then people is going to borrow more. If people is going to borrow more, then what happens is money is going to be injected into the market. So that is what called as accommodative monetary policy. Then inflation target. The inflation target of India is 4 plus or minus 2. So the upper tolerance level is 6 and the lower tolerance level is 2. If our inflation is going to go below the 2 value, then it is called as we failed to meet the inflation target. If our inflation if our inflation is going to exceed the upper tolerance level, then it also means that we failed to meet our inflation targets. So that's it. Then we have primary deficit. Primary deficit is equal to fiscal deficit minus interest payments. So fiscal deficit, from fiscal deficit the interest payment is subtracted. That gives primary deficit. So in primary deficit the burden of past debt is not added. So that is primary deficit. Then we have tax buoyancy. Tax buoyancy is nothing but if the GDP has increased, then the tax revenue should also increase. If the GDP increased and then if the tax revenue has increased, then there is a good tax buoyancy. But if the GDP has increased and if there is no change in tax revenue, then it means that is bad tax buoyancy. But why this happens? If there is a growth in GDP, there should be an increase in tax revenue. But if it is not increasing, what is the reason? There might be two reasons. One is tax evasion. There might be tax evasion by the people, or else the growth in GDP is because of the non-tax sectors. Example for non-tax sectors, we can say agriculture. Agriculture is one of the non-tax sectors because agricultural tax is not imposed by the union. Some states impose agricultural tax and some states do not collect agricultural tax. So the growth in non-tax sectors also lead to this condition. Increase in GDP, but there is no change in tax revenue. So that is tax buoyancy. Then we have capital receipt. Capital receipt make two things. One is it creates liabilities, or else it will reduce the assets. So capital adequacy. Capital receipt. So capital receipt, what it does, it will reduce the assets or it increases the liability. So it reduces asset. Example, we can say disinvestment. Disinvestment reduces the asset of the government, right? So it is an example. And we can also say recovery of loans. By recovering of loans, we are stopping our income. So generally, if we have given a loan, then we will be getting an interest from it. So the interest which we are getting is considered as the income of the government. But if we have recovered the loans, then we are not going to get anything from it, right? So it is also considered as reducing the asset. Then we have increasing the liabilities. Example for increasing liabilities, borrowing by the government comes under it. So in capital receipt we have disinvestment, recovery of loan as well as borrowing. Then we have GSEC. GSEC is nothing but government securities. Government securities are of two types. GSEC means government securities. It is of two types. One is short-term instrument, another one is long-term instrument. The short-term instrument is called as treasury bills, whereas the long-term instrument is called as dated securities. So the GSEC, generally GSEC or the debt instrument issued by the government to borrow money. It is issued by the government to borrow money. Treasury bills will mature anywhere between 91 days, 182 days or 364 days. Whereas this dated securities will mature anywhere between 5 years and 40 years. So these are the difference between treasury bills and dated securities. Then we have CAR. CAR stands for capital adequacy ratio. Capital adequacy ratio is also called as capital to risk weighted assets ratio. It is the ratio of the bank's capital to its risk. It is the ratio of bank's capital to its risk. Or else we can say it is the ratio of bank's capital in relation to its risk weighted assets and current liabilities. So it is the ratio of bank's capital in relation to its risk-weighted assets and current liabilities. So as per RBI norms, RBI has fixed cash. So if the cash if the capital adequacy ratio is high, if the bank is having capital adequacy ratio high, then it means that the bank is safest bank. Then the bank is safest and it is the healthiest bank. If the capital adequacy ratio is low, then it is not considered as a safest bank. So that is the main thing you should note. And the capital adequacy ratio which our RBI has fixed is 9%, but the Basel norms has suggested, the Basel norms 3 has suggested the capital adequacy ratio to be 8%, but our RBI has fixed capital adequacy ratio to the 9%. So capital adequacy ratio is fixed by the central bank. So these are the things which you should know relating to capital adequacy ratio. Then we have DFI. DFI stands for Developmental Financial Institution. The Developmental Financial Institution provides risk capital. They provide risk capital for the developmental projects. They provide risk capital for the developmental projects. And this DFI, the first DFI operationalized in India is 1948, and this DFI, the first DFI is IFCA. IFCA is nothing but Industrial Finance Corporation. It is the first DFI in India. Then we have some other DFIs like ICICI, 1955 we have ICICI, then we have IDBI. IDBI is in 1964. These are some of the DFI in India. Why DFI in news? Because our government has said that it is going to bring a DFI for funding the national infrastructure pipelines. So that is why DFI is in news. Then we have external financing. So external financing, what it is? External financing is nothing but getting money from outside. So external financing. So getting money from outside is called as external financing. So from outside means we can say external financing brings the foreign currency. So external financing is going to bring foreign currency, and this foreign currency can be used to bridge the balance of payment gap. So it can be used to bridge the balance of payment gap, or else we can also say it can be used to bridge the fiscal deficit. And as the money is coming from outside, it avoids the crowding effect. So crowding effect does not occur because money is coming from outside. These are the things which are related to external financing. So external financing is nothing but money is coming from outside. That is external financing. So it is coming from outside, which means it is going to bring foreign currency into the market. As it is bringing foreign currency into the market, it can be used to bridge the balance of payment gap. So balance of payment gap is nothing but we are having an export, we are having an import. For export, we are going to get money. From export, we are going to get money. We are going to get dollars. But for import, we are going to give dollars. So for this, in this we have a gap. We have a gap called as balance of payment. If our import is higher compared to that of export, we are in a deficit budget. And in that deficit budget, we need to bridge that gap. So to bridge that gap, we can use the foreign currency which we obtain from external financing. So we can also use this external financing to bridge the fiscal deficit, and it avoids the crowding effect. The crowding effect does not occur in external financing. So these are the things which are relating to external financing. And then we have bank privatization. Relating bank privatization. Privatization means nothing but the government is selling its share to the private companies. That is called as privatization. Bank privatization is nothing but earlier our government has done nationalization. Nationalization is nothing but the government will buy all the shares of the bank and the bank will become nationalized, which means the bank is under the government of India. That is nationalization. Now we are doing opposite to that of it. So government is selling its share to the private people. That is privatization. In the bank privatization, there are two committees which recommended bank privatization. So we are going to see the committees which recommended bank privatization. So there are two most important committees. One is Narasimhan Committee. Narasimhan Committee recommended bank privatization, and we have PJ Nayak Committee. PJ Nayak Committee also recommended bank privatization. So these two committees recommended bank privatization. Then we have tax revenue. So government is going to get a revenue. So the revenue that government is going to get maybe from tax or else from non-tax. So we have revenue receipt as well as capital receipt. In revenue receipt, there are two types. One is tax and another one is non-tax revenue. In tax revenue, it has direct tax, indirect tax, and in non-tax revenue, it has many things like from postal department, from transportation department, it is going to get some revenue. Those things come under non-tax things. But under tax, we have direct tax as well as indirect tax. Under direct tax, what we have is, we have the income tax, corporate tax, everything come under the direct tax. Whereas in indirect tax, we have GST. Goods and service tax is the most important one. We also have customs duty and other taxes. So the tax revenue, the highest amount of tax revenue from the government is going to the government. The highest amount of revenue to the government from the tax is from the GST. So in 2020 to 2021, GST was the biggest tax revenue source in India. So GST is the biggest tax revenue source in India. It accounts for about 28.5%. So in 2020 to 21, GST is the biggest tax revenue source in India and it accounts 28.5% of the tax revenue. And second position is corporate tax. So earlier corporate tax would be first. Now we introduced GST called as indirect tax. And by this, GST has become the first major source of revenue for the government. So it has 28.5 and corporate tax is 28.1 and income tax, the personal income tax is 28.3. So everything is so close, but GST is the major source of revenue. Then we have cess surcharge. So we have earlier seen what is cess, what is surcharge. Cess is nothing but tax on tax. Surcharge is also tax on tax. But the difference between cess and surcharge is cess, the objective will be clear. There will be clear objective in case of cess. Whereas in surcharge, the objective is not clear. That is the difference. But both is tax on tax. So in both, it is tax on tax. Whereas in cess, the objective is clear. Whereas in surcharge, the objective is not clear. And in cess, what happens is, example, we have GST cess. We can say GST compensation cess. And here surcharge, we have some surcharge. Say, this surcharge and cess, the basic thing which you should note relating cess and surcharges, it will not be shared to the state. Generally, the revenue which union government is getting from tax will be shared to the states based on the Finance Commission recommendation. We have earlier seen about Finance Commission in a separate video. So, based on the Finance Commission recommendation, the money which union government is going to get will be shared between the center and the states. But this cess and surcharge will not be shared based on the Finance Commission recommendation. That is the most important thing. But this surcharge is not shared as per the Finance Commission recommendation. Simple. But here in this cess, it is not shared as per Finance Commission recommendation. But in some cases, it is shared with the states based on some other recommendation. Example, GST compensation cess is shared to the states based on GST Council recommendation. So that is the difference between cess and surcharge. And the fact which we are going to discuss is, this is a static one. And the fact which we want to discuss now in current affairs is, cess, between 14th and 15th Finance Commission, the incidence of cess and surcharge has gone up. So between the 14th to 15th Finance Commission, the number of cess and surcharge incidents has gone up. So number of cess and surcharge incidents has gone up. That is the fact. So second fact is, if we want to bring cess and surcharge into the divisible pool of income. So divisible pool of income is nothing but the revenue which the union government is going to share with the state government is called as the divisible pool of income. If you want to make the cess as well as surcharge if you want to bring this both into the divisible pool of income, what you should do is, you should bring a constitutional amendment. So you should bring a constitutional amendment to bring cess and surcharge into the divisible pool of income. And in 2000, by constitutional amendment, in 2000, a constitutional amendment was done to keep this cess and surcharge outside the divisible pool. So in 2000, a constitutional amendment was done to keep this cess and surcharge outside the divisible pool. Now, if you want to bring it into the divisible pool, you should do constitutional amendment. That is an important fact. Then we have strategic sectors. 13. Strategic sectors. So in our government has said some sectors as strategic sectors while it was discussing about its disinvestment policy. So disinvestment policy is nothing but the government is selling its own shares, it is reducing its own share, is called as disinvestment policy, and the government, while presenting the budget, it has introduced disinvestment policy. In disinvestment policy, the government has identified 4 sectors as the strategic sectors, and those 4 sectors are, first one is, it is relating to national security. First sector is relating to national security, and this strategic sectors are the sectors in which a minimum CBSCs would be retained. In this strategic sectors, a bare minimum will be retained. So that is strategic sector. So first strategic sector is relating to national security. Example, we can say atomic energy, space and defense. So atomic energy, space and defense comes under this national security. So in these sectors, a bare minimum will be retained by the government. So national security, atomic energy, space and defense. Second one is, it is relating to critical infrastructure. So critical infrastructure, say we have two things under this critical infrastructure. One is transport and another one is telecommunication. So both of these things comes under the critical infrastructure. So critical infrastructure under which we have transport and telecommunication. And the third one what we have is energy and minerals. So under energy and minerals what we have is power, petroleum, coal and other minerals. We have power, petroleum, coal and other minerals. And in the fourth one we have financial services. In financial services we have bank and other financial services like insurance, etc. So in budget, government has said disinvestment policy, and during this disinvestment policy the government has defined 4 sectors as the strategic sectors, and one sector is national security, in which we have atomic, space and defense, and the second one is critical infrastructure, which is transport and telecommunication, and the third one is energy and minerals. And in energy and minerals we have power, petroleum, coal and other minerals, and the fourth one is we have financial services. Under financial services we have banking, insurance and other financial services. So these are the sectors which government has identified as strategic sectors. They might ask question from this. They can give these in as 1, 2, 3, 4, and they can ask which of the following are the strategic sectors. They can give in this manner. So these 4 are the strategic sectors. Then we have Finance Commission. So Finance Commission we have already seen as a video in our static question. So Finance Commission is the one which is going to divide the money between the center and the states. We know all this story. But Finance Commission will submit their reports 5 years. It will submit their report once in 5-year duration, and this duration can be extended. That is the point. This duration can be extended based on the macroeconomic situation in the country. Why it is in news? Because 15th Finance Commission is given a 1-year extension because of the uncertainties which is in the macroeconomics. So the Finance Commission will submit a report 5 years once, and this 5 years can be extended based on the macroeconomic situation, and this 15th Finance Commission is extended a year. That is why it is in news. And the recommendations of the Finance Commission will be implemented on the order of President. The implementation. So the recommendations of the Finance Commission will be implemented, right? It will be implemented on the order of the President, or it can be implemented as an executive order. But the Finance Commission recommendation is not binding. That is an important point. The Finance Commission recommendation is not binding. It can be implemented in the order of President, or it can be implemented as an executive order. So these are the things which are relating to Finance Commission. Then we have transfer payments. So transfer payments. So transfer payment is nothing but the payments, these transfer payments or the receipt which a citizen of a country receive for free. So residents of a country will receive it for free without any goods or services in return. That is called as transfer of payment. Example for transfer of payment, we can say gift, the remittances and the grants. Gift, grant and the remittances are the examples for transfer of payment. And this transfer of payments can be given by government or from private citizen of who is living abroad. So transfer payment is nothing but the transfer payments or the receipt which resident of a country receive for free without any goods or service in return. Example for transfer of payment, we can say gift which we are getting, and grants. The grants will be given for free, right? So there are grants, and the remittances which you are getting from private citizens who are living abroad. So those things come under the transfer payments. This transfer payments can be given by the government, or it can be given by the private citizens who are living abroad. Example for private citizens who are living abroad, we have remittances which they give, and the gifts, government also gives gifts, but sometimes the private citizens who are living abroad may also give gifts, and the grants are given by the government, right? So these things come under the transfer payments. So transfer payments are the one which resident of a country receive for free without any goods or services in return. Then we have stagflation. We have already seen inflation. So in our inflation video, we have discussed inflation, deflation, disinflation, reflation, stagflation. We have discussed all these things. So relating stagflation, we are going to see a key point. So stagflation is a situation in which there will be an inflation. So we also have unemployment. Generally during inflation period, there will be high amount of employment. So in inflation, generally we have high employment, but during stagflation period, we have inflation as well as unemployment. That is the key point, and also the economic growth will be slow. So that is stagflation. So during stagflation, there will be inflation and there will be unemployment. The economic growth will be slow. Those are the key features of stagflation. Whereas in deflation, the inflation will be below zero. The inflation will be below zero. The price of the commodities will fall below its normal level. So deflation is exactly opposite to that of inflation. Whereas stagflation is a condition in which there will be inflation, unemployment, as well as the economic growth will be slow. So those are the things which are relating to stagflation. And then we have fiscal deficit. So how we can control fiscal deficit? So those are the things. Fiscal deficit can be controlled by increasing the foreign direct investment. If there is an increase in foreign direct investment, many foreigners is going to come and invest in our Indian company. It is going to bring a growth in our company, so we can bridge our fiscal deficit. So increasing in foreign direct investment. And second one is austerity measures. Austerity measures are nothing but the government is reducing its spending and it is increasing the tax revenue. Both the things come under austerity measures. So first one is government is reducing the spending. So if the government is reducing its expenditure, then it can meet its income. So deficit is nothing but the difference between income and expenditure. The income and expenditure should meet. If it is not meeting and the expenditure is more, then it creates a condition called as deficit. But if the government is going to reduce its spending, then automatically it can match it. It can reduce its fiscal deficit. One thing. Or else what government can do? It can increase its income. It should increase the income to meet the fiscal deficit, or else it should reduce its expenditure. So this is the thing. So fiscal deficit can be reduced by increasing the foreign direct investment, or else by reducing the spending, or else by increasing the tax revenue, by increasing the income of the government. Fiscal deficit can be managed by the government. So these are the things. Then we have Shiftcode. Shiftcode, full form. Society for Worldwide Interbank Financial Telecommunication. So Shiftcode is nothing but it is the Society for Worldwide Interbank Telecommunication. So it is relating to international banking transaction. So it is relating to international banking transaction, and this Shift is actually a secure financial message carrier. It is a secure financial message carrier. It transports message from one bank to its intended bank recipient. That is the fact. So Shiftcode full form is Society for Worldwide Interbank Finance Telecommunication, and it is relating to international banking transaction. And in Shiftcode, what it do is, the Shift is a secure financial message carrier and it transports message from one bank to its intended recipient. So it is going to transport a message from one bank to its intended recipient. So Shiftcode is a secure financial message carrier. So those are the things which are relating to Shiftcode. Then we have NSSF. NSSF stands for National Small Savings Fund. National Small Savings Fund come under the public account of India. National Small Savings Fund comes under the public account of India, and this National Small Savings Fund, the money which you are depositing in the small savings scheme. The money which you are depositing in the small savings scheme will be credited to this NSSF, National Small Savings Fund. It is in the public account of India. As it is in the public account of India, the transaction through this NSSF do not impact the fiscal deficit. The transaction through this NSSF do not impact the fiscal deficit. As it is in public account of India, the balances into the NSSF is a direct liability to the center. It is a direct liability to the center, and this NSSF is governed by the Ministry of Finance. It is administered by the Ministry of Finance. So NSSF stands for National Small Savings Fund. National Small Savings Fund, it is under the public accounts of India. We have earlier seen three funds. One is contingency funds, then Consolidated Fund of India, then we have Public Account of India. We have discussed all these three while we are seeing the fiscal policy. So in that, the Public Account of India, in which we have NSSF, this NSSF, the money which you are crediting in the small savings schemes will be credited to this NSSF. As this NSSF is in the public account of India, it is a direct liability to the center, but the transaction through this NSSF will not impact the fiscal deficit, will not impact the fiscal deficit of the center, and it is administered by the Ministry of Finance. So these are the things which are relating to NSSF, and that is all for today. So subscribe to My Minute IAS Academy. Thank you.